Making $10,000 from stocks is a realistic goal if you follow the right strategies. You're working a regular 9-to-5 job, diligently saving a portion of your paycheck each month. But with inflation eating away at your savings, it feels like you're taking one step forward and two steps back. This is a common scenario for many Americans, but there's a way out. Warren Buffett, one of the most successful investors of all time, started his journey as a paperboy, delivering newspapers and investing his earnings into the stock market. By adopting his principles, you too can grow your wealth. In this video, we'll uncover the secrets Buffett uses to make money in the stock market and show you a simple step-by-step plan to reach that $10,000 goal. We'll look into Buffett's proven investment principles, explore the mechanics of compound interest, and reveal the strategies that can turn small investments into significant gains. Stick around because by the end of this video, you'll not only know how to make $10,000 from stocks, but you'll also learn how to avoid common pitfalls and maximize your returns. Let's start by addressing a common issue that affects everyone: inflation. Imagine working hard, saving diligently, only to find that your money loses value over time. This is what happens when inflation outpaces the interest earned on savings. Warren Buffett often emphasizes the importance of beating inflation to preserve and grow wealth. Inflation is the gradual increase in prices over time, which reduces the purchasing power of your money. For example, something that cost $100 today might cost $103 next year if the inflation rate is 3%. This may not seem like much in the short term, but over a decade, it adds up significantly, eroding the values of your savings. This means that if your money is just sitting in a bank account with a low interest rate, you're effectively losing money every year. To illustrate, let's consider the historical inflation rates in the United States. Over the past 60 years, the average inflation rate has hovered around 3.8% annually. This figure can fluctuate, with certain periods experiencing higher and lower rates. For example, during the 1970s, inflation rates were particularly high, reaching double digits at times, which significantly impacted the purchasing power of money. Conversely, in more recent years, inflation rates have been relatively stable, but still present a consistent challenge to maintaining the value of cash savings. Now, how does this affect your investments? If you're earning a 1% interest rate on your savings account, but inflation is at 3.8%, you're losing 2.8% of your purchasing power each year. This loss compounds over time, making it increasingly difficult to achieve financial goals such as retirement or purchasing a home. This is why it's crucial to invest in assets that offer returns that outpace inflation, ensuring that your money grows in real terms. Warren Buffett has often discussed the perils of inflation in his annual letters to Berkshire Hathaway shareholders. He likens inflation to a silent tax that erodes the value of money without most people noticing. This perspective highlights the importance of investing in assets that can protect against inflation. Stocks are one such asset class that has historically outperformed inflation. By owning shares in companies, you participate in their growth and profitability, which can lead to returns that significantly exceed the inflation rate. For example, over the past century, the average annual return of the U.S. stock market has been around 10%. This return not only beats inflation, but also provides substantial real growth and wealth. Investing in a diversified portfolio of stocks can therefore be an effective strategy to preserve and increase the purchasing power of your money. This approach is particularly important in a world where inflation is a constant, if often understated, threat to financial stability. Buffett's strategy involves looking for high-quality companies with strong competitive advantages. By investing in such companies, you not only benefit from their growth, but also their ability to increase prices over time, which helps to offset inflation. This approach ensures that your investments continue to grow in value, providing a hedge against the diminishing purchasing power caused by inflation. In addition to investing in stocks, Buffett also emphasizes the importance of holding a portion of your portfolio in cash or cash equivalents to take advantage of opportunities when markets are down. However, this cash holding should not be excessive, as it needs to be balanced with investments that provide higher returns to combat inflation effectively. Now let's talk about one of the most powerful concepts in investing: compound interest. This is where your money starts to work for you, generating returns on both the initial investment and the accumulated interest over time. Warren Buffett often credits his wealth to the power of compounding. Compound interest is often described as interest on interest. This means that the interest earned each year is added to the principal, so the balance doesn't merely grow linearly, but exponentially. For example, if you invest $1,000 at an annual interest rate of 8%, at the end of the first year, you'll have $1,080. In the second year, you'll earn interest on $1,080, not just the initial $1,000, resulting in $1,166.40. This process continues, with the interest growing each year, compounding with the growing balance. Warren Buffett started investing at a young age, which gave his money plenty of time to compound. He often shares the example of a small snowball rolling down a hill, picking up more snow and increasing in size and speed as it descends. Similarly, the longer your money has to compound, the larger and faster it grows. To illustrate this with a more relatable example, let's say you decide to invest $250 each month. If you can achieve an average annual return of 8%, this is how your investment can grow over time. In your first year, you invest a total of $3,000, which earns $120 in interest by the end of the year. So your balance at the end of the first year is $3,120. In the second year, you invest another $3,000, bringing your total contributions to $6,000. However, you also earn interest on that $3,100 that you had at the end of the first year, which adds $249.60 in interest. Now your total balance is $6,369.60. This process continues year after year. By the end of 10 years, you've contributed $30,000 in total. But because of the interest compounding on itself, your balance is approximately $45,000. The interest earned becomes more substantial each year because it includes the interest from previous years. Over 30 years, this effect becomes even more pronounced. With consistent monthly contributions of $250 and an annual return of 8%, your investment grows to around $360,000. This substantial growth occurs because of the interest you earn each year continues to compound, increasing the amount of money on which future interest is calculated. If you extend this period to 40 years, your investment grows to approximately $787,000. The difference is due to the compounding effect, which becomes more powerful over longer periods. In this case, the initial contributions and the interest earned in the first few years form a base that continues to grow exponentially. The additional 10 years allow the investment to nearly double, demonstrating the significant impact of compound interest. To break it down further, let's look at the last 10 years of the 40-year period. By the end of year 30, you will have about $360,000. Over the next 10 years, this amount nearly doubles because the interest earned each year is on a much larger principal. For example, in the 31st year, you earn about $28,000 in interest alone. This amount is significantly higher than the interest earned in the earlier years, showing how the compounding effect accelerates over time. The key is consistency and patience, allowing your investments to grow steadily year after year. This is a fundamental principle in Warren Buffett's investment strategy, highlighting the importance of time in building substantial wealth. The best time to start investing is as soon as possible. The earlier you begin, the more time your investments have to grow and compound. Even small amounts can turn into substantial sums over time if invested wisely. Warren Buffett began investing in his early teens, which gave his money decades to grow. This principle applies to anyone looking to build wealth through the stock market. If you're younger than 18, consider asking a parent or guardian to open a custodial account for you. This allows you to start investing early and take advantage of the compounding effect. The longer your investments have to grow, the more significant the impact of compound interest will be. When it comes to determining how much to invest, a good rule of thumb is the 70-20-10 rule. Allocate 70% of your income to living expenses, 20% to investments, and 10% to discretionary spending or fun. This balanced approach ensures that you can enjoy a life while steadily building your investment portfolio. Warren Buffett himself reinvests a significant portion of his earnings, pointing out the importance of disciplined saving and investing. It's also important to ensure that you have an emergency fund in place before you start investing. This fund should cover 3 to 6 months of living expenses, providing a financial cushion in case of unexpected events. Once you have this safety net, you can confidently invest your remaining funds, knowing that you're prepared for emergencies without needing to dip into your investments. This strategy not only protects your investments, but also allows them to grow uninterrupted. Also, selecting the right stocks is crucial for successful investing. Warren Buffett uses a combination of technical and fundamental analysis to choose his investments. While technical analysis involves studying price charts and patterns, fundamental analysis looks at a company's financial health, leadership, and market position. Buffett focuses on the fundamentals, preferring companies with strong financials, competent management, and a competitive edge. By investing in such companies and holding onto them for the long term, he minimizes risk and maximizes returns. Buffett's strategy involves looking for high-quality companies with a durable competitive advantage, often referred to as a moat. These companies are likely to maintain their market position and profitability over time. By investing in businesses that are well managed and have a strong brand or unique product, you increase the likelihood of steady growth and reliable returns. Diversification is equally important. Buffett is a strong advocate of spreading investments across various sectors to mitigate risk. One way to achieve this is through index funds, which pool money from many investors to buy a diversified portfolio of stocks. For example, investing in an S&P 500 index fund means you own a small part of 500 of the largest companies in the USA. This reduces risk because even if some companies perform poorly, others that perform well balance it out. By combining individual stock picks with index funds, you create a balanced portfolio that leverages both individual company growth and overall market performance. This approach aligns with Buffett's strategy of minimizing risk while aiming for consistent long-term returns. Diversification ensures that your investments are not overly reliant on the success of a single company or sector, thereby providing a more stable and resilient portfolio. And that's it! A step-by-step plan from the legendary Warren Buffett to make $10,000 from stocks. Remember, the key is to start early, stay disciplined, and let your money compound over time. Before you go, think about these questions. What is your long-term investment goal? How will you start implementing these strategies today? Let's continue the conversation in the comments below. Don't forget to subscribe and hit that bell icon to stay updated with more wealth-building tips.